Mergers and acquisitions offer several benefits, some of which include cutting back on taxes. An accountant must make the following inquiries. What is the target's level of tax compliance with respect to companies' income tax, capital gains tax, property tax, IT levies, and payroll-related taxes? What are the available tax assets and tax reliefs upon consolidation? For example, unrelieved capital allowances and unabsorbed tax losses. What is the quantum of non-allowable tax expense and/or deductions in the target's tax position? For example, filing fees, stamp duties, and other similar levies. And finally, what are the prospects for the applicability of the commencement and/or cessation of tax rules post-consolidation? An acquiring party may take advantage of the tax benefits available under Nigeria's tax laws in relation to interest payments if it finances the business through loan facilities. Interest expenses are specifically allowable as tax deductions under the relevant tax legislation. The assessment above assists counterparties to forestall inheriting unwieldy tax burdens in the surviving or resulting company after the ink has dried on the contractual or nuptial papers. It is therefore the responsibility of the accountant to ensure that the merger or acquisition is executed in such a manner that ensures that the company that results upon the completion of the merger or acquisition can utilize reliefs or assets in the target's books. In the integration stage, the accountant evaluates the industry and the target company's market. They also have the responsibility for predicting the company's cash flow once the transaction is finalized. The accountant will also ensure that the company is complying with the best corporate practices and that the transaction is in line with financial statutory provisions. The accountant will also make sure that all fees and levies are paid. As stated earlier, the evidence of a good business decision depends on financial returns, and so mergers and acquisitions are beneficial to the company and the shareholders when the consolidated post-merger firm is more valuable than the companies before the transaction. A good example of a successful acquisition is the bank consolidation of Intercontinental Bank PLC by Access Bank PLC in 2012. Access Bank PLC is currently more valuable than the simple sum of the two separate pre-acquisition banks. The former governor of the Central Bank of Nigeria, Charles Soludo, explained, "Mergers and acquisitions are aimed at achieving cost efficiency through economies of scale and to diversify and expand on the range of business activities for improved performance. Mergers and acquisitions are adopted to attain the operating and financial efficiencies that they bring." Mergers and acquisitions are undertaken for different reasons. At the post-merger or post-acquisition stage, an accountant may assist in achieving the long-term goals of the new company by ensuring that there's alignment of the accounting systems in line with the theory the company subscribes to. Following are three schools of thought of what the driving force behind a merger or acquisition is, that is, the theory that the company subscribes to. The first is the efficiency theory, which is the creation of more wealth for shareholders. The second is the monopoly theory, which is about the quest for increased market power and reduced competition. And the third is the empire building theory, which is about building empires and driving the building of business managers. When all is said and done, a competent accounting team will ensure that the company meets all its contractual and regulatory obligations. The accountant will closely monitor the affairs of the company once the merger or acquisition is concluded and assess the effects of the acquisition on each and every segment of society affected, including shareholders of both the acquired and acquiring companies, employees, managers, communities, customers, suppliers, the industry, the general public, and the overall economy. An important job is to maintain the investor confidence in the company. The accountant may also conduct trainings to understand the new management accounting system. More importantly, this phase helps to draw a list of priority areas to take immediate control of, to ensure the continuous flow of information for customer retention, facilitate the identification of training needs, preserve quality of data and areas to integrate, increase shareholder confidence, ensure costs are controlled and integration synergies are capable of being measured, and ultimately achieve all the objectives of the integration.